I'm Doris, and I'm here to share with you about the market. We're also going to talk about Credit Suisse. These 2 weeks have been particularly brutal for the entire banking industry, with the US economy jumping from no landing to hard landing. The odds of a recession rising sharply, but investors still do not believe that financial crisis could happen. Over the past 2 weeks, media, analysts, investors have become increasingly pessimistic about the outlook for economic growth, from stocks to credit markets to inflation expectations and the dollar. But the sentiment has not evolved into a panic over systemic collapse. The S&P 500 rose 1.43% this week, down nearly 4.6% last week. The Nasdaq, which fell 4.7% last week, rose 4.41% this week. The Nasdaq 100, which fell nearly 3.8% last week, rose 5.83%, its biggest weekly gain since November 11th. Analysts noted that the weekly rally in the U.S. meant the market was volatile by the collapse of 3 U.S. banks and the failure of Credit Suisse. But sentiment like selling everything during the subprime 2008 crisis did not appear. In crisis situations, said Matt Maley, chief market strategist at Miller Tabak Corporation, the market is full of pessimism, but it's also clear that a real crisis will not happen. If the crisis happens, we do not see treasuries going up along the big tech stocks, but only see treasuries going up. Overall, global cross-asset market risk indicators compiled by Bank of America rose this week to their highest level since October last year, but are still below epidemic and 2008 levels. The indicator measures the level of financial market stress by measuring future price fluctuations implied by global equity, interest rates, currency, and commodity option markets. Lisa Erickson, head of public marketing at the Bank of America Wealth Management, said over the phone, "We've seen considerable volatility in prices recently, and the market reflects a large degree of uncertainty, which we see through rapid changes in pricing. In terms of inflation expectations, interest rates on 2-year inflation expectations, an indicator that bond traders view inflation in the coming years, fell, hovering around 2.85% after reaching about 3.4% in early March. Analysts say that inflation expectations reflect the worst-case scenario that will not happen." On the credit front, spreads on U.S. investment-grade corporate bonds widened to a 5-month high, with the Bloomberg U.S. investment-grade corporate bond hit 163 on Wednesday. Rising spreads on investment-grade corporations bonds also often mean that investors are more worried about economic and market defaults. According to the media, the interest rate spread soared above 600 during the global financial crisis and peaked above 370 in the early days of the epidemic. Now the interest rate spread is far lower than a financial crisis, and there is no panic in the market. Sanford C. Bernstein strategist Sarah McCarthy noted that while the spreads have widened, they have not reached an all-time high and are limited to the U.S., which has barely changed in Europe, suggesting that these issues are localized in the U.S. On the foreign exchange front, there have been no flows to the dollar due to the crisis. The Bloomberg Dollar Spot Index fell 0.5% for the week. Typically, when investors feel that markets or economic conditions are unstable, they may move to money to relatively safe haven assets such as dollar, gold, or treasury bonds. The current situation suggests that, while the market believes there may be some uncertainties and risks, the mood seems to be relatively stable and does not panic or seek for risks. But perhaps there may be a hidden crisis. In terms of treasury yields, the 2-year yield curves steeply after sustained inversion, falling about 75 basis points this week. This strongly suggests that the recession is not far away. This week, European bond yields generally fell for 2 weeks after 4 weeks. The yield on the 10-year British bond fell by about 35 basis points. The yield on the 10-year bond fell by about 40 basis points, twice the biggest weekly decline in 1987. The yield on the 2-year bond fell about 72 basis points, much more than 12 basis points, mainly from the nearly 50 basis point drop on the day when Credit Suisse crisis intensified, the biggest daily decline in at least 28 years. Meanwhile, U.S. sovereignty risk has just reached a record high. When sovereign risk rises, it means increased investors concerned about the country's political and economic stability, which could lead to falling bond prices and higher interest rates. Credit Suisse fate is in the hands of these bosses. A politician, an economist, and a mathematician will be the elite who determines the future of once eminent Swiss financial institution. After a crisis of investor confidence, Credit Suisse group was plunged into emergency talks this weekend that will likely end with the breakup of the 166-year-old bank. Longtime rival UBS is in talks with regulators over which units it could buy. For the versatile Swiss banking giant, this was a dramatic loss of favor. The epicenter was made from a small group of political and financial people. Here are some of the key players. Karen Keller-Sutter, 59, has been Swiss finance minister for less than 3 months. A member of the country's pro-business liberal faction, she has been a member of the seven-man government since 2019 and was active in politics for 30 years. Prior to her election to the government, she was a board member of the insurance company Baloise Holding AG and president of the Swiss Retail Federation. Urban Anchorn, born in 1965, he has been the head of the Swiss financial regulator, FINMA, since November 2021. He worked at Zurich Insurance for 14 years and previously was head of strategy in asset management at April. Prior to that, he spent 11 years in derivatives marketing at Credit Suisse First Boston and JP Morgan Chase. He received his master's degree in physics from ETH Zurich and his PhD in the mathematics from Harvard University. Thomas Jordan, 60, has been chairman of the Swiss National Bank since April 2012. During his tenure, he led the central bank through a super expanding monetary policy phase, with the world's lowest interest rates and monetary intervention to stop the Swiss franc, a safe haven during the market pressures from strengthening. The S&P began raising interest rates in June and ended negative rates in September. Jordan studied economics and business at University of Bern. He also worked at Swiss National Bank since 1997. The UBS chairman understands the crisis. Cole Kaleller, who was chief financial officer at Morgan Stanley during the 2008 financial crisis. Mr. Buffett, 65, helped secure an emergency investment from Japan's Mitsubishi UFJ Financial Group, combined with government aid which kept the American bank alive. He then helped oversee Morgan Stanley's investment banking division, which tried to win back customers lost in the panic. He retired from the company in 2019 to join the UBS with the goal of copying Morgan Stanley's successful strategy of expanding its wealth management business to win over investors. UBS CEO James Hammer, 56, is somewhat unusual among Swiss banking executives, with a preference for open-collar shirts and business buzzwords. He was caught in legal trouble when he joined UBS from ING in 2020 because he was involved in a money laundering scandal. Since running Deutsche, he has been inspired by strong results, despite his strategy to turn UBS into a more digital bank after he was forced to abandon the acquisition of Wealthfront, an American robotics consultant. Credit Suisse chairman Axel Lehmann is familiar with two addresses on the Parade Plaza, have served as chief operating officer at UBS and president of Swiss Bank. The 63-year-old was named a safer and more native man after he was forced out of the COVID-19 quarantine leave scandal. Since then, Lehman has made a strong effort to boost confidence in Credit Suisse, including a controversial incident late last year when he said outflows client assets from the bank had largely stopped. JP Morgan then admitted that they did not see Lehman ever briefly be subject of a regulatory investigation, but that claim was later reversed. Another former UBS policymaker and chief executive, Ulrich Kohner, began working as head of asset management at Credit Suisse in 2021 and took over the top positions from Thomas Gostin last year. The 60-year-old has a reputation for relentless cost cutting, and the bank claims efforts to cut workers earlier than planned since its restart in October. The German Swiss started his career at McKinsey and was in charge of Credit Suisse domestic banking in the early 2000s. That's all I have for today. Thank you for listening. Don't forget to subscribe and like. See you next episode.